Some people have owned whole life insurance for several years and they want to get more involved with the infinite banking concept. They want to make sure they're using the infinite banking concept and their policies to the best advantage. That's good. That's what we're going to talk about right now in Wealth Talks.
We know that even if our clients at McPhee Insurance fund their life insurance policies, but never borrow from them, they're still in good shape because we design the policies for high cash value growth and they are going to last for their whole lives.
That's true. And if someone leverages the cash value in their whole life insurance policy, they can get ahead much faster financially. And that's what we're going to talk about right here on Wealth Talks today.
And I want to introduce a guest I brought to the studio today. I have known her since I was 10 years old. That's longer than I've known John and longer than I've known Tom. When I came home from school when I was 10 years old, I found someone in my room, and it was Priscilla. My mom had taken a ceramics class and she made Priscilla for me. She is a piggy bank and she's been with me all these years and I've been filling her up.
I remember I was given a little boot Cohen purse when I was little, and it was always exciting to get that thing filled up and then dump them out and find out how much money you had in it. And in The Richest Man in Babylon, he talks about saving 10% of everything you make and put it in your purse and having those gold coins dangle and jangle in your purse because it gave you a sense of self-confidence and self-worth. And it's really neat for a child to be able to hear those pennies and dimes and quarters and nickels all drop into a piggy bank. And then the time comes where you get to unload it and count it and see how much money you have.
It is exciting.
There's a limited amount to what Priscilla can hold. So when we would take the coins out, we might go spend some of that money, but I might have also put it into my savings account as a little girl. And what happens when we're saving money and we're putting money into a policy, it is building cash value that we can access if we want to, but we don't have to. We can just know that those coins are like jingling in our pocket and we have that to access if we want to.
And when you took money out of Priscilla as a little girl and you put it in a savings account or you went and spend it, you needed to fill her back up. And that's the same thing with a policy. If you're going to take a policy loan, you should have some plan on how you're going to use the money or how you're going to fill her back up if you do use the money. Because if you don't, then you never get ahead. And the difference with Priscilla or a savings account is that when we leverage the money in a whole life policy, the cash value, we don't lose the compound growth and the dividends that are going to happen on that money that's in the policy. And that is the tailwind that Nelson talks about in the infinite banking concept that helps everything we do financially perform better if we've got whole life insurance.
Well, Priscilla has her own little tailwind. I've always liked the little the little ribbon on her tail, but of course that's not the tailwind we're talking about. So sometimes people ask, when should I borrow money from my policy? Or they ask, should I borrow for everything that I spend money on?
Well, that's kind of an impossibility to borrow for everything you spend money on because now if you're going to repay that loan, what are you going to pay it with if you've borrowed everything out? If
You're borrowing for all your expenses.
If you're borrowing for all your expenses, now you just created another expense that the infinite banking concept is dependent on, and that's the repayment of the loan or at least the interest on that loan.
And even when you can borrow for a limited expense, it's not always best to take a policy loan. Take, for example, the case of somebody that has $20,000 available in the cash value of their life insurance policy and $20,000 available in a savings account. And they have a purchase they need to make for $20,000. Do they pull that from the savings or do they take a policy loan for it? If their savings is earning next to nothing, it makes sense to take from their savings and use that so they don't have the policy loan interest. But here, if we extend that a little bit further, why is the $20,000 sitting around in their savings? Is it going to be sitting there long term? Then it doesn't makes sense for that money to be sitting there long term. It makes sense to get that into a life insurance policy over the long term because it will be able to earn more even while you're not using it. And then if you need to take a policy loan for a short period of time, go ahead and do that. It's about that long-term balance in order to get the tailwind in the infinite banking concept.
Clint wrote to us just this week, one of our clients, and he was thinking about money in his savings account. He got the idea. He said, wait a minute, someone suggested I could be paying a policy loan with that money. And we said, yes, that's a great idea. Instead of using a savings account at the bank where you're probably not getting any interest, you could be putting that money into a policy that has a policy loan. You can still access it, but it cuts down the amount of interest you need to pay when you've paid down a policy loan like that. And yet he can still access that money for whatever he needs. The infinite banking concept becomes a system of how you think about handling your money.
Clint can use those vacuums of a loan that's due in a policy as a place to store money that he's not using someplace else. That's exactly what the infinite banking concept is all about. It gets rid of our need to use the banks as frequently as we do, because when we have money in a savings account, like you were talking about, John, we don't earn any interest on it when we borrow that money out to go do something with it or we withdraw it. Whereas we can borrow from the policy and still get the growth on that money while we use it someplace else. So
it doesn't change that long-term compounding curve that you get through the life insurance. You just pay interest on the policy loan while you have it out.
It's very similar to not stacking your quarters, a pile in the bathroom, some in your car, some on your dresser. Instead, you have a place to put them in Priscilla. And then anytime you need those quarters, you can come back to Priscilla and get them out.
We definitely don't want to take a policy loan for everything, which leaves the question, when should we take a policy loan? And that means that is whenever we have a need for capital outside the policy and there's an opportunity for it to grow or to save us more money than the interest on the policy loan.
I think a good thing to remember too is when we take a policy loan, how are we going to track it? A lot of times people just dip into their life insurance policy cash values like they would spend on a credit card, not keeping track of what's happening. And before they know it, they have a policy that owes a lot of interest and they're scrambling to find out where they're going to get the interest to pay for that.
It's not a problem with the policies. It's the problem with how the money was used, because people do still think in that credit card mindset sometimes. And if they apply that to the policy loan, well, it's just a bigger line of credit at a lower interest rate.
In our book, Prescription for Wealth, we talk about you don't need a whole life insurance policy to practice the infinite banking concept. You just give up the dividends and the death benefit if you don't have the policy. That's the major reason we want the life insurance policy, is we get those bonuses and, you don't have to be concerned about losing opportunity cost in the process.
Nelson Nash said that the infinite banking concept is an exercise in using your imagination. And when people ask, what should I use a policy loan for? A lot of times business owners have expenses that they have to meet, and they have to figure out ways to solve those needs. Dave, just the other day, said he's going to need $60,000 for some business equipment. He's been in business for years, but technology changes, equipment breaks down, and he has a need for $60,000 right now. So he knows exactly what he's going to be borrowing from his policy for. Someone who isn't a business owner, sometimes they have a harder time thinking of, what could I use this for? But if they've got imagination that they're using, they can figure those things out. I remember years ago, Elena, she wasn't a business owner, but she realized, hey, you know what? I could borrow from my policy to pay our property taxes and then be paying myself back. That was a great exercise of imagination. And over the years, we've provided many different examples to clients about how to pay for property taxes, how to pay for educational needs for their kids. Over and over, different examples. Sometimes people get the idea, I should borrow for all of these things. No, we're just giving different examples of what is possible. So will you borrow for each and every one of these things? Not necessarily.
Nelson was quoting Einstein when he said imagination is more important than knowledge. But reading Einstein's actual book where that quote comes from, he said that he wasn't surprised when his formula E squared, whatever it is, I can't remember.
Equals MC squared.
E equals MC squared. He wasn't surprised when that was proven to be accurate because of the knowledge that he had that he based his imagination on to come up with that formula. And that's like the infinite banking concept. If you get the basics down about how the policy works and how to manage money, then the imagination can carry you infinite different ways.
People ask us if they can have more than one policy. When we get back from the break, we're going to talk about how much life insurance coverage you should have on your life and how many policies you can have.
The policy that works best for the infinite banking concept is a dividend-paying whole life insurance policy with a paid-up additions rider. You'll want this policy to be structured to allow the maximum cash value accumulation without creating unnecessary tax consequences or inhibiting the cash value growth for future policy years. At McPhee Insurance, we specialize in these types of policies. We are licensed in all 50 states, so no matter where you're located in the U.S., we can help you. Call our office at 702-660-7000 or email us team@mcpheeinsurance.com.
We own over 30 whole life insurance policies, but that doesn't necessarily mean you should own 30 life insurance policies. How much life insurance you can have and how many life insurance policies you own are really two different questions.
When people are thinking about when to start another policy, that depends on cash flow. Do you have the cash flow to adequately support that? Some people start with big life insurance policy, and they may have fewer policies overall. Some people start with a smaller policy, and as their cash flow grows, they add additional policies. They may end up having more life insurance policies, but a similar amount of premium. So the number of policies is not the key point here.
And years ago, we had even more than 30 policies. We started policies on all of you kids, and many of you have taken over those policies now, and we have signed ownership over to you. So while we owned many more than 30 at one time, many of those policies have gone out of our ownership.
The point is that if you can comfortably afford to purchase another whole life policy, it's probably a good time to be thinking about that, because the older you get, the more expensive the insurance portion of the policy is going to become. And so if we can accumulate multiple policies while we're younger and most likely healthier, then we're going to pay less for the insurance in those policies, and we're going to have more opportunities in how we leverage those policies as we near retirement and even throughout retirement.
Well, when my mom made this piggy bank for me, she made me a pig, but she made my brother a frog, my sister a dog, and my youngest brother a pig. So we all had our piggy banks. It wasn't just like one piggy bank, we'll do it for the whole family. We each had a piggy bank. So with the life insurance, we can each have a policy on our lives, but we can have more than one policy because, maybe our financial picture changes or we want more coverage. We can purchase an additional policy, which also brings us to the question, how much life insurance should we have on our lives?
That's a good question that's asked, and it depends on who you talk to. So the industry has something called a needs analysis that they put people through, and they look at, how much money do you make, and how many kids do you have at home that you're going to most likely put through college, and is the house paid off? And a lot of those things are put into this formula, and they say, you need X amount of death benefit. And then you go about solving this by buying term insurance or whole life insurance or a combination of it until you get the death benefit that your needs analysis says that you need. But there's another way to buy whole life insurance as well.
The insurance companies' calculations are based on age and income. and you multiply that factor together, and sometimes that's more insurance than someone can afford. So we always look at what's affordable. And we use the 10-20-70 rule. 10% of your income is yours to keep. That becomes a great premium for a whole life insurance policy. Now, if that doesn't provide you enough coverage, what you feel comfortable with having for your family, think about how old they are or the expenses that they would have to cover if you weren't there, then that's where purchasing some term insurance also can come into play. So you're getting the coverage that you feel comfortable with for your family.
I think we need to stop and think about what Nelson Nash said about whole life insurance. He was a forester, and in forestry, they classify everything. And, this is a conifer, and this is a deciduous, and this is from the rose family. And he said that if we look at a whole life insurance policy, it was really misclassified. Because of the cash value buildup in it, it should have been called a personal bank with a death benefit thrown in for the fun of it.
It sure acts a lot like that.
When we look at it that way, the number of life insurance policies someone can own is dependent only what is affordable and comfortable for them. If we're going to be storing money not in Priscilla or the local bank, but in a life insurance policy where we can access it and still get growth on the money while we access it, then we want as many of those policies as we can comfortably afford in our lifetime.
Another question that comes up is, do we have to pay back a policy loan?
The answer is no. You don't have to, technically, because the insurance company only requires the premiums and interest on a policy if you have a policy loan outstanding to keep that policy going. So technically, no, you don't have to. Most people are going to want to, because that's how you replenish your warehouse of wealth.
The words we use are very powerful, and they bring with them some emotion. So in that question, do we have to? Do we have to? I'm thinking about a kid. Do we have to put money in Priscilla? Well, it can be a great joy to put money in Priscilla, and it can be a great feeling to start paying back that policy loan so we can access it again. And Priscilla here, she has a rubber stopper. So if we're putting money in here, we can access it again. And that's true with a whole life insurance policy as well. You start paying back that policy loan, you can access that money again. It's not like you have to break the bank to get the money back out.
When people access the money from their life insurance policy, or I should say against their life insurance policy, because they're using it as collateral and leveraging it and getting the insurance company's money, they can break the bank. They can break that policy if they decide, I'm not going to pay the interest back or the principal. And now what happens is the interest on those compounding loans gets so exorbitant that the bank is broken.
Yeah, because the interest, if they're not paying it every year, it adds to the loan balance and it does compound. If you pay it every year, it's not going to compound like that on you.
That's right.
Some people see borrowing from a policy and paying it back just as a game that they're playing. They're not really borrowing it for a certain purpose and then systematically paying it back. They're just borrowing it and then maybe paying it back real fast. Maybe not even borrowing it for a purpose except to borrow it out and put it right back. And there's been some confusion in the industry, maybe some things that they've heard about infinite banking that is false and giving them the idea that it's just a good idea. But if I just take the money out of Priscilla and then I just put it right back in, take it out the bottom, put it back in the top real quick, that doesn't really do anything except keep me busy.
It doesn't. And the idea behind putting money in Priscilla in the first place is so that you could take it out and create something of value with it. That's the same idea with a policy. That's the whole idea of building wealth. It's more than just an accumulation of money.
Nelson Nash said it's all about how you think. And this concept is becoming your own banker instead of letting the banks. So we have to think like a banker when we take a policy loan. No banker wants you to take a loan today and pay it back tomorrow. They need the interest that is going to be generated from the loans that they give. Otherwise, they can't stay in business. And so for you to get ahead using the infinite banking concept, borrowing from a policy and paying it back immediately, it's going to break the bank.
I can think of an exception of when someone might pay a loan right back immediately. And that would be if someone was planning to make a purchase, like say Dave said, I need that $60,000. And he gets it over to his account. And then for some reason, he decides not to buy that equipment. Well, he doesn't have to just keep that $60,000 in his savings or checking account wherever he deposited it. He can go ahead and just turn around and pay that loan back. So we have to think about what is our purpose in borrowing that money, and we just need to be a wise handler of our money, not just think that this infinite banking concept has got some magic about it that we have to figure things out. Just think about how you're managing your money.
And you can be strategic about this. I worked with Kurt just the other day. He has policy loans outstanding, some for business purpose, some for personal purpose. And as we were looking at his strategy in repaying these loans, it's going to take him a little while to pay back the policy loans that he has. So he's going to focus on paying back the personal loans first with principal and interest, while he pays interest only on the business loans because he gets a tax deduction on the interest on the business side.
So that's very strategic about how he's going to do that. That's going to put more money in his pocket, in his control. And he can do that because he is the money manager.
Another reason someone might repay a loan is that they take a loan from their policy and maybe they're paying 4.5%, 5% for that loan, and they find someone that will loan the money to them for 2.5%. And now they go, oh, well, this makes sense just to pay back my policy and use this other money because my policy is going to continue to grow just as if I didn't have the loan, or if I had the loan, it's not going to affect that. So using someone else's money in that time is a way a real banker would look at it, and it's the way we need to look at it as well.
Just like it's important to live a balanced life, it's important to extend that concept of balance into using the infinite banking concept as well. If you ask somebody how to live a balanced life for them may not be a balanced life for you. What you can learn about and apply is you could take the principles of living a balanced life and you can build your own balanced life. Those principles hold true across the spectrum.
Some people call our office and they say, well, I want to buy 2 policies right now. One for, $20,000 and one for $5,000 on my life right now. And that makes very little sense. If you can afford $25,000 in premiums, you should focus it all on one policy right now, because later you can buy another policy if you want to. But if you split that policy up immediately, then you're paying at least about $75 a piece on the policy fee annually on 2 policies. So why spend $150 when you can pay $75 and have more cash value to manage yourself?
And there's a couple other ways to look at this. If they can afford $25,000, but not all of it right now, well, maybe a semi-annual payment might be a good way to have that policy paid. Or maybe if they just can afford the $20,000 that they know for sure, maybe they start that policy and in a few years they say, yeah, I do have this $5,000 consistently. That's a great time to buy another policy. So don't go in, don't spend more than you can afford to do. But when you can start adding policies while you're young, do it, because that'll give you another depositor into your money management system.
One time when somebody might split a premium that they can't afford into a couple of different policies is when they want to put some of the insurance on each of the spouses. That makes great sense to go ahead and split the premium. And I can tell you that when somebody is getting closer to their golden years, it helps to have money in multiple policies for more strategy, more options as we think about passive income for those golden years.
People often ask, when do I know it's time to buy a second policy? And there's several little things that can happen that can trigger you're saying, maybe I should. Let's say that someone takes a policy loan and they're paying off a huge debt like Ethan did, okay? Now, as Ethan pays that back, he was used to paying 18% interest to his creditor beforehand. And if he continues paying that 18% back to a policy that's only charging 5% interest, he's going to fill that policy up.
And he's going to have extra.
Yeah, it's not going to take the extra 13%. So where does that money go? Well, it can be used in the banking system by lending it back to himself, or if it's sufficient enough, he can buy another policy with that. Maybe it's not on him, maybe it's on one of his kids. The other thing is that when someone starts the infinite banking concept early in life, they're probably not at their maximum income level. And so if we go back to the 10-20-70 principle, and you're supposed to keep 10% of everything you make, as our income goes up, we need to be thinking, oh, it's time to buy another policy while I'm young and relatively healthy with this extra money that's coming in. Because if we don't purpose to keep that 10%, it will make wings and fly off to heaven like an eagle. The scripture tells us that.
If it were possible to maximize the financial benefits of your life insurance by owning 5 policies or 10 policies, taking a loan every 2 years and using it to buy some widgets and paying it back at 10%, we would tell you. But it's not.
What makes you feel successful in your life may not be the same thing that makes us feel successful in our lives. Success with the infinite banking concept is more about how you think and how you manage your money.
Being more involved in the infinite banking concept boils down to understanding how money really works and being able to use that knowledge to manage your money better. Hopefully, you are increasing your understanding and knowledge by listening to Wealth Talks.
Next week, we have a guest who's an attorney. He has a wealth of information on asset protection, very important, and we like the fact that he tells lawyer jokes. Come back next week to listen into our conversation with this attorney right here on Wealth Talks.